Part 1, Chapter 11, we're going to cover the allocation of long-term assets. Now, the definition. Property, plant, and equipment and intangible assets are purchased with an expectation that they will provide future benefits, usually for several years. Now, these assets are required to be used as part of revenue-generating operations. That means they're used by the business. If they're not, then they would be categorized as something else, like an investment or inventory. But you can only allocate these costs if they're used to generate revenue for the business. The acquisition costs of these assets should be allocated to the periods benefited by their use. We have three methods. Depreciation. This is used for tangible assets, plant and property, and equipment. Amortization is for intangible assets. These usually, you do not have a separate account for these, whereas depreciation you do. You have an contra account called accumulated depreciation. For intangible assets, normally when we write it off, we take it directly against the asset account. And we have depletion, which is what we use when we buy things like oil or gas or gold mines, and as we use it, we then write it off. We have a couple methods for that. Now we're going to cover depreciation. This is the process of allocating the cost of property or plant assets over the period they are expected to produce revenue. They must also have a useful life greater than 1 year. That's very important. If they have a useful life of less than a year, then you would expense it. There are two approaches. Time-based. Cost is allocated based on passage of time. The example would be straight line. Or activity-based. An example there would be units of production or units of activity. Now, how do we determine depreciation expense? Now, first of all, we have to figure out what is the cost. And as we covered before, it's in Chapter 10, it's all costs associated with getting it ready for its intended purpose. The next thing we have to guess is at the end of its service life. Now remember, service life is not the same as the life of the product. It's how long we're going to use it in the business. When we buy it, we have to estimate, is it possible we could sell this item at the end of its service life and get some cash for it? Okay? That's called resale value, and it is an estimate. What is the service life? Again, that is how long will the business use the equipment. What is the date of the purchase? This is important because it affects the first year of depreciation, in some cases the last year. What is the depreciable base? This is the maximum amount we can allocate. This is always going to be the cost minus any amount that has been allocated over its lifetime. What depreciation method should you use? It all depends. Most people use straight line, but we're going to go over different methods. Now, we have these methods. The requirement is that it has to be systematic and rational. And when you go out and work in accounting, you'll find that there's all kinds of methods. All right. There's activity-based. This is units of production or units of activity. Straight line, this is the one that's used by most companies because it's so easy, and normally they don't assume a salvage value because it's who keeps track of that stuff. Okay, sum of the year's digits, declining balance. These are called decreasing charge methods, and then we have the group and composite methods or a hybrid or combination method. These are ones that are unique to certain companies, and these are special methods. Now, other issues. Partial year. If a company purchases equipment other than the first day of the year, you have the option of using the nearest month. Now, the way it works, if the date is between the 1st and the 15th, you get the whole month. So if you buy it on August 2nd, you would be able to depreciate the whole month of August. If you get it on August 16th, you do not get to depreciate that month. This is the method we use for our homework problems and in this presentation. You can also use the half-year convection, where you get a half a year in the first year and you get a half a year in the last year. the nearest fraction where you do it by days, or a full year in the first year and none in the last year, or none in the first year and a full year in the last year. But again, we use nearest month for these homework assignments. So now let's take a look at an example. Now, what we are going to do is we purchase something on August 1st, which means it's going to be partial year. We know what the total costs are. We know we have a salvage value and we have the useful life. So we know the cost, we know the salvage value, we know how long it's going to be, we know the estimated hours, and those are the things that we always look for first. And what we're going to do is we're going to do straight line, activity method. Now when you do the activity method, they have to give you the actual usage. Remember, these numbers are used specifically for allocating the amount of depreciation for that year. The estimate is the one that you use to come up with the rate. The actual is how you determine how much to allocate. So please remember that. People always get confused about that. Then we have the sum of the year's digits. I don't even know why I discussed this, but it's in your homework, but I don't know anybody that uses that. And then we have double declining balance. Now, sum of the year's digits and double declining balance would be used if you want to write that depreciation off right away. Now, let's look at a summary. Now, what I like to do when I'm addressing a problem, I first take a look at what are they asking me to do? What information do I need so I can solve the problem? So in this case, we know the total cost is $117,900. We know the estimated service life is 5 years or 21,000 hours. So that's what we're going to use to come up with our rate. The actual usage is going to be used when we go to determine how much to allocate each year using units of activity. The salvage value helps us to determine the depreciable base. And the date of purchase will tell us in this case that we have to use partial year, which is important for some of the depreciation methods we use. So first year is going to be 5/12. So now take a look at, let's look at straight line. Now what's the formula? It's cost minus salvage or residual value divided by service life. Always gives you annual depreciation. To get monthly, you divide by 12. Then to come up with an annual rate in our example, it's 21,000. That would be used if and only if we are going to have a full year. So also you need to remember what's my depreciable base, because this is the maximum amount that you can allocate over the life of the asset. So now we come up with a little schedule that I use. The first year, since it is partial year, what we're going to have to do is take it times 5/12. So we're going to take that 21,000 times 5/12, and that gives us our first year depreciation. And we have the net book value. Now, I always like to keep track of that because remember, we cannot write off more than 100. We cannot write off more than 105,000. So now I do my next 4 years, which includes a whole year, which is our 21,000. And then I have my last year, which is only going to be 7/12 because I have to take the... Now, if you notice, when you have a partial year, it drags it out to 6 years because you're getting 5 months in the first year and 7 months in the 6th year. So, I know that the maximum I can write off is 105,000, so that's what accumulated depreciation, which should equal, because accumulated depreciation is the maximum you can write off over the life of the asset. And we also know that the net book value has to equal the salvage value at the end of its life. So again, remember, depreciable base is the maximum you can write off in any of the methods that you use for your books. Now let's take a look at activity based. Now first you're going to come up with a rate, which is going to be cost minus salvage value divided by total estimated usage over the life. That's the number that you estimated. So in our case, what we're going to get is $5 an hour. Now we're going to take that $5 times the actual usage each year. This method is not affected by when you buy it, because the actual units you produce are what's going to affect the allocation. So in the first year, we're going to take $5 times 1,000 units, and then we're going to keep doing that for each year. Now, here's the thing you always want to make sure of, is when you add up those units, that they don't exceed 21,000, because 21,000 is the maximum number of hours you can allocate. So if you were to add them up, in this case, the amount that we estimated equals the amount that we used. And if you notice, again, accumulated depreciation equals 105, net book value equals 12,900. So again, this method's not affected about when it's purchased. Now, some of the year's digits, this is a tricky one. All right, first determine the fraction. I have two methods. You can add up the years, 5, 4, 3, 2, 1, or what you can do is use the formula, which is years plus 1 times years divided by 2, and you'll get the correct. That's the easier way to do it. So, years fraction equals years remaining divided by the factors. So, in the first year, year 1, it's 5 divided by 15. In year 2, it's 4 fifteenths, then 3 fifteenths, then 2 fifteenths, 1 15th. Now, the problem you have with this method is if you have a partial year, you're going to have a partial year for the whole 5 years. As a matter of fact, it goes into 6 years. So, what's going to happen in year 1 is you're going to get 5 fifteenths times 5 months divided by 12 to get your depreciable amount. That's going to be times your depreciable base. In year 2, you're going to get the 7 months from year 1, and you're going to take 5 years from year 2. So let's walk through this to see what this looks like. So, year 1, you get 5 twelfths. Year 2, you're going to get 7 twelfths times the 515, and you're going to get 5 months times the 415. And you're going to have to keep doing that each year. And then you go into the 6th year with 1 15th times 7 twelfths. So that's how you do that. And if you notice in the end, you still end up with accumulated depreciation of 105 and net book value equals salvage value. So, it cannot exceed. Now, what about, you can look at that for a few minutes. You can also look at these. I do post them. Now, what about double declining balance? Okay, you're going to take, this is affected by when you buy it, but only in the first year. You're going to take 1 divided by the service years times 2. And in our example, we get 40%. And then depreciation expense is always going to be depreciable base. No, it's always going to be, net book value times the rate times the month, and cannot exceed the depreciable base in the end. So in this case, you don't consider depreciable basis until the end. That's why you need to keep track of accumulated depreciation and net book value. So here's our first year. It's going to be $117,000, which is our cost, times 40% times 5 twelfths. Remember, you have to take that into consideration in the first year. Year 2. You're going to take $117,000 minus your accumulated depreciation, because it's always times net book value times 40% times 12 twelfths, because it's the whole year. And you're going to keep doing that. But remember, keep track of your accumulated depreciation, because it cannot exceed 105. So in this case, in the 5th year, it's a plug. Now that concludes part 1.